All right, folks, I think we're going to get started here. Just first, thanks for being here. This is kind of our first time doing something like this, kind of targeting that younger generation, some basic finances and somewhat of a seminar, right? So appreciate your feedback after this. Let us know what you thought worked out, what you think we could improve upon. Just keep it nice a little bit with the criticism there. I'm Zach Zarda. I'm a financial advisor at Caliber Wealth Management. Brent Bloomer is going to be joining us up here as well. He's another advisor and our Director of Advice Solutions at Caliber. Really what we want to achieve today is we're going to keep it kind of quick. We're not going to actually take 2 hours of your time, even though you might have RSVP'd for that. But really what we want you to come away with is just some basic understandings of personal finance and definitely some action items to take away so that we didn't just learn something and then forget it, whenever you drive home today. We really want you to take an action of, okay, this is something that I'm going to change or I'm going to do as I move forward in my career or in just your budgeting or whatever it may be. It's up to you. So with that, why we're here and why it matters. You're here probably because you either just started earning some money or you're about to. And starting early is one of the best things that you can do in creating good habits in personal finance. And we'll show you some numbers on and actually some data on the benefits of starting early with investing and compound interest. But I will tell you that you're actually already ahead of the curve just by being here. Most people are pretty financially illiterate, and just being here, you're going to be one step ahead of the crowd. So good work on you. There we go. So to start, we'll just cover some basic common mistakes in personal finance. How to master cash flow, how to tackle debt, the power of investing early, how to set some financial goals, and planning for some life transitions and a few other things along the way. At the end, we'll have a little bit of an interactive workshop. You'll see at the back of your packets that we have something that you can fill out and setting some of your own personal financial goals, some action items that you want to take away, and actually just a little bit of an outline for like a rough budget, if you will. So some of the top 5 mistakes that people make in financial planning or lack thereof, more likely. Number 1, I'd say, is living beyond your means. Spending in life, your lifestyle expenses is I'd say increasing your living expenses is like going on a float trip. Whoever has been on a float trip in here? Anybody gone down? Pretty easy, right? Just sit on a little tube, maybe have a beer. I don't know if you're of age. Pretty relaxing. It's the natural flow of things. However, cutting lifestyle expenses is like trying to swim back up that river without a floaty. So it's good practice to start early and, if possible, live below your means as long as you possibly can. One of the best pieces of advice that I actually got from a non-advisor as I was starting my career before I was in wealth management was live like a broke college kid as long as you possibly can. And what that ended up doing for me is allowing me to purchase my first home. And I didn't have to start with a starter home. Now, home prices have gone crazy since then, but it really made a significant impact. That just little piece of advice made a significant impact on my life, my family's lives. Number 2 would be lack of an emergency fund. One of the ways that people tend to get into debt is that they just miss this piece. If you can put away 3 to 6 months of living expenses, well, then you have the flexibility to handle unexpected expenses. And that's what ends up happening in debt, is where hey, I had a medical issue, I got in a car accident, something that you just didn't plan for. And if you don't have an emergency fund, well, how are you going to pay for that? Well, my credit card, and well, we'll get into what that looks like in the long term. And then number 3, I'd say, is not budgeting. So just a failure to budget, not even trying. So what I would say on budgeting is that a budget is not a restriction. It is a tool for financial freedom. So it's not, a budget sounds like a bad thing. In my mind, it always did. It always sounded like, oh, I'm putting reins on, and restrictions on my own spending. It doesn't feel comfortable. But what that allows you to do, once you kind of get used to it, it allows you to understand and actually be able to answer the question of, can I afford this? Because if you do this properly, then when there's something that you really want to spend some money on, you'll have the financial freedom potentially to actually be able to afford it. Losing it? Okay. Number 4 would be ignoring retirement savings early in your career. We'll tackle this in more detail later, but starting early, again, you're going to hear a theme of this, is one of the best things that you can possibly do. Understanding what a 401k is, what the match on a 401k means, what a Roth is, Roth IRA, Roth contribution. They sound like jargon. They're very simple if you just distill it down. So hopefully we just walk away from here and understand that, hey, it's not really that overwhelming. And then a debt spiral. So if we don't have that emergency fund, what's the result? We get into a debt spiral where we can't afford the interest on the debt that we accumulated. So in order to avoid some of those pitfalls, a couple of things that we can do. Budgeting. There's a couple of things we can do there. There's different apps. The internet's full of them. Dave Ramsey's a big proponent of some. He has some of his own, and I encourage everybody just to go check out a lot of them are free. Understand which one works best for you. Just try it out. Link it to some of your credit cards or your accounts to understand where your money's actually being spent. It'll actually open your eyes quite a bit to some of the things that you didn't understand, what subscriptions you may have had that you didn't even know that you were spending that much money on. Again, building an emergency fund. And then the 50-30-20 rule is kind of a rule of thumb where 50% of your income should be allocated to your needs. That's like your fixed costs, right? That's your rent, your food, right? Your grocery bill, your utilities. 30% of your spending should be on wants. So that's travel, right? That's eating out. It's a different thing than groceries, right? That's going out with your friends. That's doing all the fun stuff is wants. And then 20% goes to savings or paying off debt. Credit card debt, hopefully not, but student loans, most likely, right? And then another good practice is to pay yourself first. So just automate it. Don't even make it optional. The mind is, a wise man once told me, my father, the mind is never more resourceful than when in self-justification. So if you think about that, it is, if you give yourself the option to justify living outside of your budget, or hey, I'll make it back up next month, you're going to probably make that a habit, and that's not a good habit to start. So a practical application here for that emergency fund that we've talked about is to set a ceiling and a floor for your checking account. That's generally where you want to park your emergency fund, in a high-yield savings account or a checking account. High-yield savings account just generates a little bit of interest. You can still access that money any day you want. You can go to the bank, go get cash out of it, right? But it yields right now around 3.5% or so. So some easy liquid money at a bank nearby somewhere, so that you want to set that ceiling and floor. Maybe that's, $15,000 to $10,000. You want to have a balance between there for yourself. Maybe that number could be, depending on your expenses, $25,000, $15,000. If it gets beyond that amount, say, hey, that's a good problem to have, right? You're accumulating quite a bit of cash. Your cash flow is positive. Well, then if you have too much in your emergency fund, you're really not putting all your money to work. So that's where you want to start pumping a little bit more into your investments, right? And if we see that emergency fund start hitting the floor where, okay, I wanted it at 10,000 and it keeps every month, I kind of have to put more in there than I want to. I have to cut back on expenses. Well, then we have to reassess the budget, right? That's a good alarm system for us. Having a ceiling and a floor where, hey, I know if I'm within this range, I'm comfortable. For tackling debt, if there's a client who comes in my office and says, yeah, I've got all this money over here, I've got this account, I want to invest this, and then, oh yeah, I ask them about their assets and liabilities, debt, and they say, oh, I've got a little bit in credit card debt. That's a bullseye right there. That's my number one target. I've kind of clear everything off to the side and say, okay, how are we approaching this? Because this interest rate, national average, around 23%, honestly, I see way above that on average. It is a complete wealth destroyer. So if you look at these numbers, these are real numbers, and using a 23% number of interest, if you have $10,000 in credit card debt, and you only make your minimum payments, it can take you over 50 years to pay off $10,000. And that would result in a $38,000 payment in interest alone. That's not paying off the principal. That's not $38,000 total. That's $38,000 plus the $10,000 that you already spent. So what's a good practice? Automate it. Don't let yourself be, justify it in your mind. Just automate it. Set it and forget it. If it's not there, find another place. Like, you have to avoid credit card debt like the plague, to be honest. Payoff strategies for student loans and credit card debt, if it happens. There's two approaches. There's the snowball approach and the avalanche approach. Mathematically, you're going to say, okay, well, I want to pay off the highest interest rate first, right? That makes sense on paper. It does work on paper. Depending on who your advisor is or how disciplined you are, it may not be actually the best approach for you, though. Dave Ramsey, for example, not to preach his gospel so much, but he always recommends the snowball approach because psychologically, you see progress. So if you're unsure of which one you want to do, I'd lean actually toward the snowball approach, even though it doesn't seem as good on paper. But actually seeing progress in tackling one category of debt studies have shown that it actually benefits long-term debt reduction. So, and honestly, again, we're going to rehash this theme of the emergency fund. The emergency fund is going to help you avoid sudden debt, right? That's our best tool in the toolbox right there. All right. And here it is. Investing early is retiring rich. This is the magic, guys. Compound interest. So what is compound interest? Well, it is, I would say it is growth growing on your growth. Now, that's not a good thing to hear from your dermatologist, but that is something that you want from your financial advisor, right? So it is about time in the market, not timing the market. So there's, if you can see this, probably not, $50 invested monthly for 20 years in the S&P 500, right? Broad's U.S. stock market index, right? If you invested $50 a month, not a big balance, for 20 years, that's $12,000 invested. You generated $3,736 in dividends. You end up paying taxes on $670, or you pay taxes of $670. We actually threw some fees in there to be generous to ourselves as well. And then you have an inflation-adjusted return. So we're actually accounting for inflation in this number as well. If you just did $50 a month for 20 years, that balance right there, that number, if you can read it on your sheet, is over $44,000 $12,000 over 20 years turns into $44,000. Pretty much magic. $100 a month makes a difference. A Roth IRA and a 401k, Brent, you were going to cover some of those details later, but those are some of the most tax efficient tools to do that. And they're not that complex. It's just about when it's taxed and how it's taxed. There's two aspects there, nothing crazy. And it is about being consistent. You don't have to be perfect. You don't have to, I would actually tell you, the top 3 millionaire jobs in America, what do you think they are? Any guesses? What's just throw out a career. What do you think, a doctor maybe would be a top 3? Nope. Doctors acquire debt. They all have tons of student loans, right? It is engineers, accountants, and teachers. We all know how much teachers make, right? What do engineers, accountants, and teachers have in common? They're structured, they're organized, they're disciplined. Teachers don't make that much money. They make enough to become millionaires, though, because they do this, right? They have a state-sponsored retirement plan. They put it in. Everybody does, basically, like clockwork. They become millionaires. I got my laser beam there. So investing simplified, right? It can be an overwhelming topic, all right? What are stocks, bonds? I don't know what this means. Risk tolerance, all this sort of stuff. All right, let's boil it down to its simplest terms possible, right? Diversification. It is just spreading out your investments over a variety of asset classes, industries, sectors, etc. That just means, hey, I don't want to put all my eggs in one basket. I'm not going to put it all into one stock. The S&P 500 is a great example of this. It is 500 of the largest U.S. companies that are public companies. What is a stock? An equity. It is simply a share of ownership in a business. You actually start owning some of that business. What's that business worth? Well, it's worth whatever earnings it has, and it is worth what people are willing to pay for it on the open market, right? That share of stock. It is simply trading ownership of a business, publicly traded. What is a bond or fixed income? Same thing, right? You are becoming the bank for either a municipality or another business, a company, right? So you are loaning your money to receive interest payments. Sounds like debt, right? Except for you're the benefiting party, right? Same thing. Now, of these two, equities tend to be more aggressive. They grow more upside. We'll show you on the next chart a graph for that. But and then fixed income, much more predictable, cash flow oriented. More conservative though, because what ends up happening is if once your fixed income matures, you get all your money back and you just received income payments along the way, right? So the idea is to find the right mix of those equities or stocks and bonds that is of the right risk tolerance for you, right? How bumpy of a ride can you handle? So here's an example of 3 of our portfolios, honestly. If you have, this is a 10-year time horizon. So aggressive, that light blue line is 100% stocks. This gold line, moderate, is 60% stocks, 40% bonds. That's what you would consider like your moderate risk tolerance. A lot of people nearing retirement end up around this bucket. And then conservative, if someone is very, very risk averse, they can't handle any bumps along the way investing-wise, right? Well, then they lean toward conservative. This is 100% bonds. That's just the bond market. So what stands out here? We ended up with, we started with $10. I actually have notes on here because of what the actual number is. We almost tripled our dollars over 10 years in this aggressive bucket. 100% stock. Stock market basically tripled over the last 10 years. The moderate portfolio did really well. It's that $10 became $22.62, so 2.2 plus times our return here. Not bad. Conservative, what did that do? I'm getting addicted to this little laser beam. We had a 40% gain. We had a 40% gain on the conservative, right? So we have 300% return, 40% return. Now, that doesn't tell the whole story though, because look at the ups and the downs along the way. So the purple line, actually right here, was short term, was above both stock portfolios for an entire year. So if your time horizon's short term, say, hey, I want to buy a car in the next year. Maybe something between these two or around here might be appropriate for you. However, or if, hey, I have some money on the side, I want to buy a house in the next 2 years. You're probably going to be somewhere between these two, right? If you're nearing retirement, you end up somewhere around here. But hey, if you're putting money into your 401k at work, your retirement plan, well, that's not money you're going to touch for 40 years, 35 years, right? Where do you want to put it? Now, what you want to avoid, though, is freaking out here, right? Because what happens if, oh my gosh, the world's falling apart, COVID, right? That's COVID right there. I want to cash out. Well, you just lost out on that. That's half of the gain of this entire thing, is in the 2 years after the sharpest fall. So it is about time in the market, not timing the market. Whenever you're investing and you take an action out of fear, it's probably the wrong thing to do. Fear should not dictate your investments. Your investment decisions. Your risk tolerance should. And your risk tolerance is whether or not you're willing and committed to riding out those bumps. So here's another example of compound interest. Account growth of $200 invested or saved monthly. So we'll start with the green, right? The green is a consistent saver. They saved $96,000 from age 25 to 65. 40 years, they saved $96,000. And the cash actually earned in a high yield savings account 3.1%. They were very conservative. They saved really well though. This gray line, right? Early saver and investor. They saved $24,000 from 25 to 35. That's just 10 years. They only saved for 10 years. Only 24,000, not 96, 24. And that earned them 7.25%. Look what that is. That's over $100,000 more. They saved for 10 years instead of 40 and ended up with $100,000 more at the end of the day. All right, the late saver. So, hey, I'm just going to get by for my first part of my career. When I make more money, I'll start saving then, right? I'll start saving then. They're behind. They ended up saving $72,000. They saved a lot more than this guy, right? They saved 2/3. They saved 3 times more than this guy did. Earned the same interest. And they saved it for 30 years. Not 10, 25 to 35. They saved it for 30 years. They ended up with less money. How did they do that? Because they missed out on the most important part of the entire investment cycle here. It is the starting early. Again, it's magic, that time in the market, not trying to time the market, right? Ended up with $40,000 more almost. All right, and here's the magic though, right? All right, let's be committed to it. Let's save the same amount this guy saved, green guy, except for we're going to save it and earn on it. We're going to put it in the market. modest return for stock portfolios, 7.25% per year, right? Over 40 years. $96,000 turns into over $500,000. It's kind of magic. That's how teachers become millionaires right there. All right. Is this where I had you going on here, Brent? Yeah. We can. Do we want to take a break? Does anyone want to take like a 5-minute bathroom break or refreshments? No? All right, let's march along. All right, Brent? Yeah, here you go. Brent Bloomer, everybody.
That's right. That's right. Appreciate that. Yeah. Well, thank you, Zach. Obviously, a lot of good information that he's provided with just general theme. Earlier you start, the easier it is for yourself. Also, what he touched on is, early April this year, accounts hit 15% down in a 1-week period. That's when panic selling takes place, and it's easy to do that. But what those people did that panic sold is locked in their losses and then missed out on the upside coming back. So keep reiterating what Zach's already alluded to. Time in the market has proven to be much more successful than trying to time the market. You may get it right every now and then on the timing side, but historically, you're going to get it wrong more than you get it right, and it costs you money. But moving on, something that we've heard a lot about in the news here the last few years, and even more so again with how tariffs or one big beautiful bill may affect inflation. But one thing for certain, inflation is real, and you've got to plan for it. And the best way to do that, keep harping on what Zach talked about, is save early and invest those dollars. If you keep them in a checking or savings account or buried under something in the backyard or under your mattress, it's safe, it's there, but you're actually losing money over time because it's not keeping up with inflation. So Zach put this together, but it is interesting. Good way to see what inflation has done over time is the Big Mac index. What did a Big Mac burger cost in 1967? So, a while ago for sure, but it was under 50 cents for a burger. You fast forward to the year 2000, it's about 2.25. Now we're at about $5.80, and give it another month or two, it'll probably be up to closer to 6. That's just the way things are going. So, not everything inflates over time, but pretty much everything does. Some of the examples that I can think of where prices have actually come down would be flat screen TVs or tablets or computers, where maybe it's some technological advancement at the time, but then there's a way to mass produce these for cheap. But groceries have been in the headlines a lot recently. Egg prices finally coming down some, but beef tied to the Big Mac is at all-time highs right now. So what does that mean as far as investing goes, as well as basically when we forecast a financial plan for people, we have to factor that in. Because if you're like, oh, yeah, I can retire with $1 million. Well, $1 million today will buy you a lot more than what $1 million will 30 years from now. To be exact, if we average 2.5% inflation over the next 30 years, that would be the equivalent of $467,000 in today's dollars. So basically halves your buying power 30 years from now. So with that in mind, again, when you have time on your side, being in the market is the way to make money grow and keep pace and hopefully beat inflation over time. So moving on of talking about invest early and do this and that and compound, where do you invest the dollars? Zach already touched on, stocks and bonds and the differences between those, but now we want to look at what account types make sense to invest in and what differentiates them from each other. So here's a nice little grid that kind of shows, the differences between them. The plus sign means, there's some sort of tax benefit involved. The minus sign means you're not getting any tax benefits from it. So if we start with just the normal traditional 401k and traditional IRA, the big benefit on those is you get a tax deduction in the year that you contribute to them. So let's say, you make $50,000 and you contribute the maximum amount of $7,000 to a traditional IRA. In the eyes of the government or IRS, when you're paying taxes, it's as if you made $43,000. So that $7,000 that you contributed to the IRA, that's not going to be taxable to you. So that's where you get that benefit in those years. Same with the 401k plan. If you get $1,000 a pay period and you're saving 10%, that means you're really only being taxed at that $900 because the $100 that's going into the 401k is tax deductible to you. So it grows tax deferred as well, so you don't owe any taxes on any gains or dividends made in that account over time. Where you do finally owe those taxes, because the IRS or government hasn't gotten a penny from you on those since you put those dollars in there, is they tax you on the back end when you pull those dollars out. So for an example, if save a lot, let's say we do the $400 a month example. Zach did the $200 that got you over $500,000 30 years down the road. If you do $400, we'll say it's an even million that you have. Well, if it's all in that pre-tax bucket or the 401k or traditional IRA, that's really probably closer to about $750,000 once you factor the taxes in. You got a lot of tax breaks along the way, but it's time to pay them on the back end. The other option, and basically the complete opposite of that, is the Roth IRA or Roth 401k. That is where you don't really get any sort of tax benefit in the years that you fund the account. So you're paying taxes on the dollars that go in there. The benefit is it continues to grow tax deferred, so no taxes owed while the money's in there. And then when you pull it out, using that same example, if you do the $400 a month over the next 30 years and it gets you $1 million when it's time to retire, you get to keep all $1 million of that. No taxes are owed on the federal or state level with the Roth IRA. So very powerful account. In a slide or two, we'll touch on maybe when it makes sense to use one versus the other. The other two options, the after-tax 401k, wouldn't worry too much about that right now. That's just, if you've already maxed out your 401k, which is $23,500, you can save more into an after-tax bucket. So you're not getting any tax savings on that as far as deductions go, but it has the same benefits as kind of the pre-tax 401k or traditional IRA in that you don't owe any taxes on the growth. When the money comes out on the back end, anything that you put in the form of contributions on the after-tax side isn't taxable. Anything that grows from those contributions, so if you put $50,000 of after-tax contributions and it grows to $75,000 when it's time to retire, $50,000 you're not taxed on because that money's already been taxed. You funded it with dollars that had been taxed. The $25,000 that grew from that 50, you're going to get hit with taxes again on the back end. Last but not least, health savings account. This is where you kind of get the best of all worlds. Does it make sense for everyone? Not necessarily, but it's definitely worth taking a look at. This it has to be used in tandem with a high deductible health insurance plan. But again, very generally speaking, usually less health issues the younger you are, so this is a way to save money when you may not have regular or larger medical expenses. Those dollars that you contribute in there are you get a tax deduction on them. You can keep it in cash or you can actually invest those dollars over time. They also grow tax deferred, so don't owe anything on the gains that occur year to year. And then in retirement, so long as they're used for qualified medical expenses, you can pull them out tax-free. The biggest benefit here is there's no statute of limitations on reimbursing yourself for those medical expenses. So if you have the cash flow to cover most of them just out of pocket, this account can grow over time. You get to retirement. Hey, if you saved your receipts or have, health insurer records, you can reimburse yourself for something that happened 30 years earlier. So that's a way to have tax-free income in retirement from a health savings account. It could also be used for long-term care needs if that's ever an issue down the road. Just basically having that extra tax-free bucket to either reimburse old medical expenses or potentially use for future health issues down the road. So those are kind of the four main places to save. If we fast forward again here, just kind of the question we get a lot is, well, so should I save into the pre-tax 401k or the Roth 401k with the employer? One, it's a good question because it means you want to save in one or the other, and that's the most important thing is saving. But what typical rule of thumb, and every situation's a little bit unique, is in those early years, save it in that tax-free bucket, in the Roth IRA. Two reasons for that. One is if you want to have the most growth, you fund those accounts early, and that's the one that you'll never pay tax on again for the rest of your life. The other two reasons, which are important, is you're probably not going to be making the most money of your working life in those early years. That's probably going to be, it varies for everyone, but say after the age of 40, maybe even 45 to 60 or 65 is when those peak earning years usually kick in. So any tax deduction you may get from the pre-tax 401k, yes, it's beneficial, but it'll be more beneficial down the road. And if you do the work early, skip out on the tax deductions in the early working years, you'll get rewarded for it on the back end with those tax-free dollars. The other reason why the Roth can sometimes be of benefit in the early years is because those dollars you use to fund the Roth IRA specifically. So 401k, Roth 401k is a little bit different, but anything you put in a Roth IRA, you can take out without penalty or charge. Now, we don't recommend that. It's not why we open up Roth IRAs to use as a savings account, but that flexibility is there. Now, any growth inside of there, you'd owe taxes plus penalty, but it's a very powerful account that highly recommend in those early working years. But then the script can flip a little bit later on where, hey, if you're in a higher tax bracket and earning good money, well, you've got enough in the tax-free. Let's shift and get those tax savings year to year, where that can be thousands of dollars per year that you're saving in taxes. So really having a balance between the different account types is what we ultimately want to achieve. It's just the timing of when it makes the most financial sense to save into each of those. The other question, and I don't have a crystal ball. Don't think anyone in here does, but if you had to make an educated guess, just kind of where we're at, debt as a country, probably an increased probability of taxes being higher in the future than they are now. No guarantees on that, but that could be some of the rationale as well where, hey, do I want to be pulling money out of a traditional IRA or 401k in retirement when taxes are higher? Or would I rather, save into the Roth IRA while taxes are relatively low right now? So again, this more of a conversation that is based on personal situation, but just general rules of thumb there. So yeah, kind of that priority. If you have $1, there are a lot of different places you can put it. On the savings side of things, as Zach mentioned multiple times, build that foundation. Get your emergency fund created and set up. Whether that's 3 to 6 months of expenses or whether it's, I want to just set a dollar amount. I want it to be $50,000. Whatever that number is, build it up. Like he mentioned, the consequences of not doing so are if if you need new car tires or a trip or whatever the case may be, you're having to use the credit card. And that can start down a slippery slope if not careful with it, whereas if you just have the cash available, that eliminates that problem. Next is defined contribution. So that would be the employer retirement plans, or 401k, 403b, TSP, whatever the case may be. The benefit there is not always, but more often than not, the employer will offer some sort of match of whatever you contribute. So, let's say you contribute 10%, the employer will match 5% of that. All of a sudden, you're now saving 15% into retirement, and you're also getting free money. If we use that same $50,000 salary as an example, that equates to $7,500 going into that 401k each and every year, $2,500 of which is coming from your employer. So don't leave free money on the table. At least save up to what the employer will match. Next, as Zach also alluded to, work on paying down those high interest loans. Usually it's credit card debt. Some student loans, especially maybe some of the more recent ones, might be a little bit higher as well. Getting those knocked out just will improve cash flow down the road and save you a lot on interest payments. From there, health savings account we talked about, usually through the employer, that high deductible health plan is, whatever's left over, put it in there. If you still have more left over after the health savings account, you can put a little bit more into the employer 401k plan, or maybe we look at some mix at that point of, hey, you're already putting in more than what the match is. Maybe we could shift some of that to pre-tax and you save into a Roth IRA outside of your employer instead. Again, finding that mix, but if you have the excess cash flow to do it, all you're doing is setting yourself up for success and funding things early. Number 6, pay down lower interest loans. So that may be more of the student loans. Maybe let's see if interest rates get back down, but houses for a while, there were very low interest rates where sure, it feels good to pay it off, but if you're paying 3% interest, you could probably make more by saving that somewhere else. 7, I kind of touched on it, where it can be kind of synonymous with number 5, is if you have those excess dollars, figure out where the best place to save them is, both from investment options and tax purposes. And then number 8, which we haven't really talked too much about yet, would just be a taxable account. So that's the account type where you're funding it with after-tax dollars. You owe taxes on any gains, dividends, or interest from year to year, albeit they're at preferred tax rates, but it's also the most liquid to you. Those 401ks, traditional IRAs, Roth IRAs, those are all tied up, I should have mentioned this earlier, until age 59 and a half. So there are exceptions when you can access them sooner, but generally speaking, those are retirement accounts that there's a penalty to access, especially on the pre-tax side before 59 and a half. So this taxable account would be, maybe for that first home purchase or wedding or new car, whatever the expense may be. But the way those capital gains work is if you bought a stock for $10, sold it a year later for $12, you're going to owe, say, 15% tax on that $2 gain that you had in that stock. So that 12 to 10. But bottom line, if we make it to number 8, you've had a good job, you're doing a lot of things right, and we'd be happy to help you with that situation. So with that, I'm going to switch it back to Zach to wrap up, and then we'll definitely address any questions that you have.
Yeah. We'll power through here, guys. Thanks, Brent. I would also say to rehash some of what Brent just said on this. This priority list is not set in stone. So I created this slide. I should be able to dismantle it a little bit, give myself a little freedom there. But it's totally dependent on your goals, right? So this is kind of like a guideline, if you will. But if you do have a goal, like Brent said, of, oh, I want to buy my first home. Well, if that's a major goal of yours, we're going with number 8, right? Assuming a couple of these things are already taken care of. We don't really want to use other funds to achieve that goal. That's something that we would target a taxable account. So that does change some of that hierarchy, if you will. All right, setting and funding goals. Some common financial goals, right? Buying a home, just talked about it. Paying off debt. It's a great goal, right? Start a business. A lot of time that takes capital, right? Sometimes some of that capital may be in the form of debt, which can be good debt. Debt's not all bad, right? If it's earning you more than it's costing you, that could be good debt. Business is a good way to achieve that. Travel, right? Practical. Hey, life's to be enjoyed too, right? We're not just trying to accumulate money here so that we just have a pile at the end of our lives to die on, right? We want to enjoy life. That's a great goal. SMART goals. It's just a goal-setting strategy. You guys have probably all heard of this, right? SMART. Is it specific, measurable, achievable, relevant, time-bound? So when you're setting goals, financial goals, all right, let's put some hard numbers to it. Let's put some hard actions to it, right? Let's make it realistic, though, right? And a way to achieve those goals, again, automate savings towards your goal. Once you have it measured, it's actually pretty easy. So give us one of us a call. We can do that for you. There's calculators on the internet where, although don't trust everything you find on the internet, you can automate your savings toward that goal, toward each goal. Just make it happen. You can automate. You can set it up. We have clients set up for monthly contributions to different accounts for specific goals. I got clients with car account, house account, retirement account, right? And we just set it and forget it. It just happens, right? So automate it. Be like the teachers. All right, planning for life transitions. All right, life does not happen. My favorite phrase that I came up. Life does not happen according to a spreadsheet. Life changes. So you get new jobs. We lose jobs. That's what that emergency fund's for. We're going to hear it again and again. We get new jobs. What's one thing we want to ask about when we're applying for a new job? It's what are the benefits here, right? Do they offer a 401k plan? Who does not know what a 401k plan is? Phil, you okay? You're getting called out. You're getting thrown under the bus there, Hobbs. Yeah, 401k plan. It's just an employer-sponsored investment vehicle. It's through your employer. They have some custodian, which, hey, what's a hex? It's just a bank that holds the money, right? And you invest it in there. And so it's not overwhelming, right? Just understand what their match is. Are they? If you put in 5%, are they going to put in 5% too? If you put in 10%, are they going to go 6%? You just understand what that means, and because that's essentially, if they're contributing 5%, that's a 5% raise, right? It's not on your salary. You're not paying taxes on it yet, but it's going into your account. Health insurance, along with the HSA, they're tied together, right? Do they have health insurance? How much are they contributing to your health insurance? Do they match? Do they totally pay for your health insurance policy? Some employers do that. Most don't. Some do. Health insurance is it's one of the biggest. If you're looking at your budget, you just started a job. Take a look at how much. That if you go onto one of those apps and you track every dollar, keep an eye on how much is actually being spent on health insurance. It'll make your eyes pop. It's a huge dollar amount. What's it, 20-something, it was near 20% of people's expenses oftentimes in retirement go toward health insurance. And an HSA is only available to high deductible health plan policies. So it's the most common type of health insurance policy, but if you're making a choice of, hey, I don't know what a PPO or an HDHP is, the higher deductible policy is generally cheaper, but you have what's called a higher deductible, right? Deductible is just what you're going to end up paying out of pocket when you go until you get to the point where the insurance is chipping in more, right? So you're taking on a little bit more risk there. You're paying maybe a little bit less than a PPO, but you have access to this HSA plan with that potentially. If you're moving, understand what a mortgage is. Simply your loan to the bank is loaning you money to buy the house, right? Closing costs, agent fees, all that sort of stuff when buying a house. It actually costs money to get a mortgage, not just the interest itself. There's insurance is the big one, right? Property taxes. You look at a house, you do, I can afford this payment, and you forget to add in what property taxes, what insurance policies you're going to require for that home. All of a sudden, that mortgage payment doesn't seem so easy to make. Understand what that is before you commit to a home purchase, right? Also, home purchase. What goes in a home? Everything, stuff. You buy your first home, you're coming from a dorm room, you're coming from an apartment, you're gonna have to fill it. If you don't have the funds if you have just the funds to make your down payment, and you don't have funds to put anything in it, it's gonna be a pretty empty house. You're not gonna feel like home for very long. So don't become house poor. Understand what you can actually afford, and that you can actually upkeep it. Because that's another thing is understanding what if you're buying your first home and you're new to home ownership. My basement flooded this month, I think, with a lot of other people's basements. So understand what that costs. It's not cheap to maintain a home, right? It might seem like, oh, I'm building equity. I'm paying myself with this mortgage, right, versus paying rent. Well, you forget the $1,000 remediation bill that's going to be there because it rained 10 inches overnight. If you have a side hustle, good idea is set up separate finances for it. Understand actually how much it's making you, right? How much it's actually costing you. And then it'll actually allow you to potentially write off some things, right? We won't get too deep into taxes or anything like that, though. And marriage and cohabiting, right? Paying for a wedding, understand how that's going to happen. But also just talking finances with your partner, right? Make sure you're on the same page. One of the top 3 or 4 reasons that marriages end is financial stress, financial conflict. Set expectations early. Just communicate, be on the same page. It's just a healthy practice. All right, guys. I have a task for you today, right? You have homework. We're going to make you do it right now, though. On the back of this here, we have a space for 3 financial goals. Big, small, long-term, short-term, doesn't matter, right? Let's just go through it. Write down 3 of your biggest financial goals. Some of the practical ones we talked about, buying homes. Retirement is actually a goal. I want to live abroad, take a sabbatical, do whatever. Like the world, these are your goals. There's no right or wrong goals to have. It's our job to help you achieve them. After we get through that, we have a little bit of an outline, just a rough outline for budgeting. So how are we going to create a budget? Well, we gave you a couple ones to fill in for yourselves, but there's going to be a lot more on here that you have to fill out. Understand first what you're actually making. Understand what you're taking home, how much of that is actually going to taxes. And then you can, once you understand what you're actually making, then you can create a budget of your own. A good starting point for that is looking backwards at your credit card statements, right? Categorizing some of those those old those previous expenses. So let's not forget about your utilities, your health insurance again, big one, often forgotten. And then that'll unpack how you can save, right? And that'll give you freedom to save, because you know where your money's being spent, you know how much you can save, and you can have comfort and peace of mind in that, right? A budget is a tool for peace of mind. It is not a tool of oppression. All right. Yeah, budget deal, we're probably going to do that more so at home, but the financial goals, I think that's a good practice to figure out right now. I'll give you guys just a couple minutes. See people wrapping up a little bit. All right, and then the last thing that I'm going to ask you to do is just take at least one, two if you're ambitious, just one savings or investment action that is going to help you specifically achieve one of your goals. Write it down, commit to it. If you feel like you need to go through the ritual of signing your name by it, go ahead. It's not a contract, but just commit yourself to an action item to take home and actually do. Whether that's, hey, I'm going to go change my 401k contribution when I get home. I'm going to go sign up for it. I guess next slide is our thank you slide. Art is gone. So if you guys have any questions, that's the end of the show. But you can follow us on our social medias, and if you have any questions after this, feel free to reach out to Brent, myself, anybody at Caliber. We're just here to help you guys out. So thanks for your time, guys. We'll get you out of here early.